We are live.
Okay, so I'm going to try to bring them to order.
You're muted. You can press *6 anytime to unmute yourself. You're being asked to unmute yourself. To unmute, press *6.
At least we're getting your echo. At least if you could hear us, if you could unmute.
Can you hear me now?
We can hear you now. Perfect.
Okay,
With no echo.
it didn't work. I thought maybe I could do the visual on the WebEx, but that didn't work. So I'm going to call the meeting to order. And the first order of business is the approval of the audit meetings from July 13th. If I can have a motion.
I so move.
Okay, and a second.
I didn't attend that meeting. I actually attended.
All right, then I guess I can second it. Aviva, do you have any comments about the minutes? Any adds, additions, questions?
No, fine.
Okay, so all in favor, aye?
Aye.
Okay, so minutes are approved. With that, I'm going to turn things over to Melinda to give us an update on the audits.
Hi, good morning. Thank you. So for the first item on the agenda is an update on the audits of the Auditors of Public Accounts. Since our last meeting, the state APA has released a few reports for fiscal year 19 and 20. They released Southern, Charter Oak, and Eastern for fiscal 19 and 20. And then for fiscal 18-19, they've released the CCSU audit. We have received and responded to a draft of the CSU System Office report for fiscal 19 and 20. And we are also just awaiting the finalized release of the Community College System report for fiscal 18, 19, and 20. I will move on to the next item unless anybody had any questions on that.
No.
The next item is just the year-end audit and discussion. I will start with the 2020 bond audit. That fieldwork was completed during the summer of 2021. Fieldwork completion and deliverables were timely this year. We do have Cone Resnick on here to give us an overview of that a little later on, so I will just leave it at that and not go any further in depth at this point. The foundation financial statements, as you know, those are included as a component unit of our financial statements, the colleges, universities, and Charter Oak. The foundation audited statements were much timelier this year. As you know, last year, there were some timing issues due to the pandemic with some delays in field work for a few of those audits, but we did not experience similar delays this year. All the reports that we received were unmodified. However, we are still waiting on the audited financial statements for Capital Community College Foundation. As far as the financial statement audit, this year, the fiscal year close went very smoothly for the colleges, universities, and Charter Oak. I want to especially emphasize that the college's financial statements and audit files were completed weeks ahead of last year. Believe the audit team was very pleased with preparedness this year. I'll leave it to Claire to talk more about that, but I'm very happy with how things went. Want to commend the accounting departments at the system office, universities, and Charter Oak for all their hard work this year, continuing to work remotely and getting things done with the audit. I do want to note that during the close for the colleges and universities, there were 2 adjustments discovered by management and corrected. We will go into a little more detail on those during Grant Thornton's presentation, but I just wanted to emphasize that these were found and corrected by management. It did not come up during the audit. It came up during financial statement close process. So overall, just happy with, finding those errors and making the corrections this year. One other thing I wanted to note is implementation of Gatsby 84. We had touched upon this briefly in the past meeting. Gatsby 84 is fiduciary activities, and it requires us to present the activity of agency accounts such as student activity funds on the face of the statements and in a separate statement. The guidance allowed us to assess quantitative materiality, and we concluded that the fiduciary funds were not material to the financial statements, not material to university, Charter Oak, or the colleges, and therefore we did not make any change to historical presentation this year. We will, however, review and assess materiality annually to make sure that, if those balances, if those accounts do become material, we will be required to report the funds and activity separately in those separate statements. That is all I have to report. Mike, did you want to add anything?
Nope. When we get to Charter Oak on the adjustments, I'm happy to speak a little bit more in detail, but nothing from my angle. Thank you.
Well, thank you. And I feel like I'm flying a little blind here, so because I can't see anybody in the meeting. But either Melinda, Ben, or Pam, if you can do me a favor. We do have a new member of the audit committee that I should have introduced. I want to make sure that happens. And at the point at which the members of Grant Thornton who are here, if we could introduce them, because I believe we have an additional member of their team who will be joining us today.
Yes, Elisa, thank you. We'll do that.
Okay.
Okay.
And for everyone here, I'd like to introduce Rick Porth. He joined the board, and there he is, and he requested to be on the audit committee. So we appreciate his service and his expertise, and look forward to his great questions and his approach to audit.
Thanks,
Well,
Pam.
Rick, I am so glad that you volunteered to be on the team, and I really do look forward to the day that I can actually meet you in person and we can sit across from one another during the next audit committee meeting.
Thanks, Elise. I appreciate that. And I actually did ask to be on the audit committee, and I'm glad to be part of it. Looking through the materials for today, it's pretty daunting, but I know I'm working with a lot of good people, so I'm happy to be part of the team. Thanks.
Thank you. And the team has been great. And I should say this, and Aviva probably knows this too. When we get the daunting material and we need some some more information to help us understand what we're looking at, the team has been terrific. And I spent a little bit of time this week with Melinda going through the material. So thank you.
Great. Thanks, Elise.
Okay, so now are we going to turn things over to, who is it, Ben, Melinda, Mike?
The next, I think we're going to turn it over to Grant Thornton.
Oh, okay. All right. So, Claire, it's on you. And if you could introduce your team.
Yes. Thank you, Elise. And thank you to the committee for inviting us to present the results of the audit today. So I have several members of my team with me, 3 of the managers from the audit engagement, Matt McCormick, Chris Bradford, and Dave Stoffel. And then I have Dennis Marone with me as well. He is a partner in our, he's the national industry managing partner of our higher education and not-for-profit practices. And he serves many not-for-profit and higher education clients himself as an audit partner as well. So we plan on discussing the results of the audit today, or the audits, excuse me, of all 3 entities. We'll go through that. And then we thought maybe if time allows, Dennis would just spend a few minutes, very brief, to make some comments on just the industry as a whole and what he's seeing across the country due to his work as our national industry managing partner and working with many different higher education organizations across the country, just to give some perspective on what's going on in the both the opportunities and the challenges that higher education is facing, excuse me, as an industry. So I think with that, we can go into our required communications. So I believe in the material that starts on page, let's see, page 41 of 264. On the bottom of the slide, it's page 40, but if you're using the to navigate to it, it's page 41 of 264. So I think I'll turn it to Dave.
All right, thank you, Claire. Good morning, everybody. As Claire said, I'm going to be starting on page 41 of 264. This just goes over our significant risks for the audit. And these are the same risks that were presented in the meeting in July. These are standard to all of our audits over tuition or revenue for most audits, and then management override of controls. We executed the audit plan as we presented originally in July with no significant deviations in the testing plan. As you'll see noted on here and then the next couple slides, we do have some adjusting entries that Melinda had mentioned before. I'm not going to go into too much detail on that, as Matt will be covering those a few slides after. But just wanted to point out that the plan, everything went to plan as far as testing for the significant risk areas. If you scroll down to page 43 of 264, it goes into depth over some other areas of focus for our audit. These were not determined to be significant risks, but are areas that require testing from our team. Similar to as presented over the summer, everything went as according to plan. There was no additional testing identified during the course of the audit. And as mentioned, we did have adjusting entries within these areas, which Matt will go over in the following slides. And so I will stop there. If anybody wanted to discuss any of the areas that we have presented on these 5 slides.
Can I ask a question? Your reference to a page, slide 8, and then pages 10 and 11 in some of these areas of focus, I couldn't find that. What does that reference refer to?
Yeah, apologies, Aviva. The page numbers sort of, we had a standalone presentation and we were referencing those pages. So essentially what we're trying to reference is, I'll go to it in the document with the 264 pages. So it's page 40,
It should be
47 and 48 of 264. Those are the 2 pages. And essentially what we're trying to say is, for all of the areas of focus, we had no exceptions except for the audit adjustments that were summarized in those 2 slides.
Right. Okay,
So,
I was happy to know that because they sounded very minor, and I thought maybe I was something major that I couldn't find. Thanks.
yeah, no, I'm sorry about that. Page
No problem.
numbers are tricky.
Is that the page, Claire, is that the page where it's the second page of the summary of adjustments where it says corrected and uncorrected for CSUS, CCC, and COSE?
Yeah, that same reference, page 8 and
yes,
so forth. It's not, that doesn't work.
Yes. Right.
Okay.
And also, Elise, the 2 pages that say, maybe you're saying the same thing. At the top, it says summary of adjustments.
Yes.
Yeah. Okay. Yes,
Thanks.
those are the 2 pages we're referring to.
Thanks a lot.
I ask a question, Elise? This is Rick.
Yes. Okay, Rick.
And this might not be the time in this meeting, or this might not even be the right meeting, but in looking through some of that material, there's a reference to a change in the way Gatsby requires us to record pension and OPEB liabilities. first of all, let me ask, if this isn't the right time, maybe I need a side conversation too, but I want to make sure I understand what that means for us as an institution in terms of our own liability for pension and OPEB.
I think it is. We've talked about this in the past, but I think this would be a good opportunity to refresh our memories and to sort of bring Rick up to speed on sort of the reference. I think, Melinda, you made to Gatsby earlier.
Thank you.
Elise, this has been, if you don't mind, I wouldn't mind giving a basic response to that question, and then maybe some of the accounting nuances can be picked up by my more erudite colleagues. And several years ago, I couldn't remember the exact year, the Gatsby required us to report on pension and OPEB liabilities as part of our financial statements. We are essentially assigned a portion of the state's large unfunded pension and OPEB liability. Both, it's for the SERS system, which is the largest of the state's retirement systems that impact us. There's a small amount of unfunded liability from the teachers' retirement system, which is ascribed to us because we have some small number of staff who participate in that system. And then the OPEB trust, which was established about 10 years ago and is significantly unfunded at the state level. We are assigned a portion of that. Personally, I don't believe that it is that the Gatsby requirement that we report these liabilities does not, in my view, change CSCU's legal responsibility for those payments. Those are obligations of the state of Connecticut to its retirees and its current employees. And we pay a mighty amount of unfunded pension liability in the form of fringe benefits payments to the state of Connecticut each year. So what we pay for fringes for our employees cooks in, I think accurately or in a reasonable way, our share of the unfunded liability costs. However, we are also required to report those on our balance sheet as deductions to our net position. Though actually it comes up later on in the discussion item about some policy revisions. We have developed a practice which I intend to propose be enshrined in our policy, that we view our net position for the purposes of determining what our reserves are, institutional reserves. We look at our net position and then we back out the impact of the pension OPEB liability on those reserves. So our net position is billions of dollars negative each year because the unfunded pension liability that we are responsible for swamps the value of our colleges and university campuses and our cash and everything else. So we show with this massive negative net position. However, when we adjust for that, we come to a number that is meaningful as our reserves, given that the funding of unfunded pension and OPEB liability are managed through a separate budgetary mechanism of allocating fringe costs to us, and that the state is currently, I believe, on a responsible, if long path toward restoring those funds to full funding. So that's sort of where we are. They show up if you look at our balance sheet there, it produces these almost meaningless negative numbers at the bottom, which are very hard to understand. Movement around the actuarial valuation of our pension and OPEB funds has more impact on the bottom line of our balance sheet than our operations now, which is discouraging. Having our operations be kind of hidden within our financial reports is frustrating. So that's why we make an adjustment outside of the financial reporting process to calculate what our reserves are, excluding the impact of those. But if you have questions about how we're supposed to handle how we reflect them, I would defer to Melinda or Claire or one of Claire's colleagues on that question.
Thanks, Ben. That's really helpful.
Ben, that's the best summary I've heard in a long time, because I know we've been focused on this for a few years.
Yeah, and we'll be focused on it for the rest of my career here, because our repayment of our unfunded liability has more longevity than I do.
Richard, everybody who comes on this committee has that same first question.
Yeah.
Thanks, Sue.
Thank you.
Actually, Ben, it's actually misleading, and it's much harder to understand what's going on because of that inclusion.
Mhm.
It is. And Rick, just to give you a little bit of history, when the regulation first came out, we challenged it. And not only we did, I think other organizations did too. But we didn't get very far with the challenge, and this is where we are today.
Interestingly, Rick, at the time that it came on, I was sitting on an advisory panel at Gatsby and was one of a minority of members of the advisory panel who represented issuers of financial statements. So there were a few folks from government and a whole lot of folks from the bond markets. And the folks from the bond markets carried the day, as they do at Gatsby every time. And additional reporting requirements were placed on that were protective of bondholders. At the expense of the workload of my colleagues here at CSCU, who have to put this all together and then figure out how to explain it so that it's meaningful to government users of financial statements as opposed to financial sector users of financial statements.
Thanks for the context.
Okay.
So I think
Claire?
we can continue going through the required communication. So I think maybe we're turning to Matt.
Yes, thanks, Claire. Good morning, everyone. Matt McCormick, Audit Manager with Grant Thornton. So I'm going to be picking up on page 47 of 264, or slide 46 in the deck. It's a summary of adjustments continued. So you see, we did have a few both corrected or uncorrected misstatements at each of the entities. Can go through them in detail, if anything, and also let management comment on them. I think the overarching premise is that, while these are being presented to you, they do not rise to a level that's material to each of the individual entities' financial statements. Rather, it's above a trivial threshold that we set for each of the entities. And then our professional standards do require us to communicate these. I think generally you'll see across the board that the nature of these are net zero to the P&L. A few reclassifications, as well as a couple items where management had a reconciliation difference between what the state was reporting and worked with them to resolve that. Happy to dive in. Also happy, I know Mike, you maybe wanted to speak to the Charter Oak ones. But yeah, I just want to see if there's any questions regarding these. I think holistically, though, not material to each of the entity's financial statements. So not something that we thought needed to be corrected if not be so.
And to maybe state the obvious, they won't impact the report that we issue. We will issue an unmodified report or a clean report. Because as Matt said, these are either A, they were corrected, or B, they were uncorrected but not considered material.
Any questions from the regents on the summary of adjustments?
No.
Okay, so scrolling down to 48, from an internal control perspective, our responsibility as auditors is to obtain reasonable assurance that the financial statements are free of a material misstatement. And part of that is a consideration of internal control. While we do not test the operating effectiveness of internal controls, we do review to identify potential control findings and then assess those from a severity perspective that I kind of view in a layman's terms as kind of a stoplight, green, yellow, red. in kind of ascending severity. We put the terms to those being control deficiency, significant deficiency, and material weakness. So, stepping back a bit, we did not identify any material weaknesses in the course of our audits. We did identify one matter that we evaluated and discussed with management and felt rose to the level of significant deficiency. Thus, we're going to be communicating that to you today. That's listed on page 50 of 264. So this was a control finding stemming from one of the adjustments to net position, effectively a reclassification between the investment in plant and unrestricted net position financial statement line items. So a zero impact at the total bottom line, but we felt from a dollars perspective and how, based on the processes and controls that were in place, that this warranted communication to the audit committee. We've listed a recommendation here, and I think management has already taken some great steps to beef up the processes and controls around this area and remediate that going forward. I can speak further to any questions on this. Though just want to reiterate though, as our testing is not, over the operating effectiveness of controls, and it's not designed to detect every single control matter. There might be significant deficiencies or material weaknesses that we did not identify, but this is just specifically what came up in the course of our audit.
And this also will not impact the report that we issue. It doesn't change our report. It's just something we need to communicate to you. So it doesn't go anywhere else other than within these required communications, but we're still issuing an unmodified opinion on the financial statements.
And I think, for some of the members that have been with us for a few years now, we've seen, I think, a really good trend, especially on the CCC side of things, to improve processes and controls there and remediate findings that we've had in prior years. So, kudos to Melinda and team there. I think, we're very happy with the results and the timing this year for sure. So if no questions on these slides, I'm going to pass it over to my colleague, Chris. Thank you, everyone.
Thank you.
Thanks, Matt. Like Matt said, I'm Chris Bradford. I'm an audit manager with Grant Thornton. So I'm going to pick up on slide 50, quality of accounting practices. The only significant change to accounting policies this year was the adoption of Gatsby 84, which I know Melinda has already discussed. So I don't think we have to go through that again. On this slide, we also break out some of the significant accounting estimates. I think these are all ones that are going to be consistent with the prior year. In terms of disclosures, there was a disclosure for the correction of the error, which we've already discussed, and all disclosures within the financial statements are materially complete and accurate. Moving to the next slide, other required.
If I can interrupt you for 1 second, Chris, just as a reminder to the committee, one of the reasons why we specifically mention the areas of that involve significant estimates is because there's a particular risk associated with estimates because they're based on management's judgment and not necessarily always a sort of hard calculation, mathematical calculation of an account, that we want to make sure there's no bias by management, either conservative or aggressive, from year to year, that would indicate that they're trying to manage to a certain bottom line number. And as you could see, we didn't have any adjustments related to any of those significant estimates. So we felt comfortable that management's judgment was appropriate within, a reasonable range of what would be considered material. And that's an important part of what we focus on in our audit, is making sure that they don't have a bias and then they're not trying to manage to a certain number. So thank you. Sorry, Chris, go ahead.
Thanks, Claire.
What's the page number, Chris?
So this is going to be page 50.
Thank you.
Yep. So continuing on, professional standards require that we communicate the following matters as applicable. I think the vast majority of these were not applicable to this year's audit. I think the main thing is really the items we already discussed, the significant deficiency that was identified, but you know, like I said, I think the vast majorities aren't applicable for this year.
And I would say one of the items on the list here is if we did have significant difficulties with the audit, we would need to communicate that to you. And I would say it was quite the opposite, where, as Melinda was alluding to, the community colleges particularly, this is the earliest they were ready for us this year. I think now that Melinda's got a few years under her belt, it's been, you know, she's able to get through the close process fairly efficiently, and was ready for us better than I've ever seen. So I really appreciated that. I know, and the team did as well. So we just wanted to acknowledge that.
The other thing that I want to acknowledge, I echo what Claire just said, but each year what I see is when there is something identified, whether it's, you know, sort of, even if it's a minor issue, what I appreciate is that there's focus on how to ensure that corrective action is taken and that it won't happen again. So it's a focus on continuous improvement. And I think that's one of the reasons why, as an example for the community colleges, the process has continued to improve.
Okay, so I'll continue on to just briefly go through a couple slides on the Gatsby technical updates. So Gatsby 87 leases is going to be effective for FY22. Management is actively assessing the impact of the adoption, and this will, of course, be subject to our audit procedures next year. So I'll continue on unless there's any questions or anything the committee wants to discuss on this.
No questions from me.
No questions.
Okay. So I'll continue on to the next slide. Gatsby 89, accounting for interest cost incurred before the end of a construction period. This standard is also going to be effective in FY22, and management is also actively assessing the impact of adoption. And this will, of course, be subject to our procedures next year as well.
So I think that wraps up our required communications. If time allows, Dennis maybe could just spend a few brief minutes giving an overview of the higher education landscape.
Would that be okay with the committee?
Yes, I would appreciate that. We
Sure.
all would.
Thank you.
Sure. So I'm happy to give some perspective. And as Claire mentioned, I'm our national managing partner. So I spend a lot of time meeting with boards and finance and audit committee meetings talking about things like this. And so, you know, over the course of the year, it's obviously been a very turbulent year for higher education in general. But hopefully there is at least some signals that things may be improving in the coming months and year perhaps ahead. It's certainly fair to say that the recovery across institutions, whether they're public or private institutions, has been different, and it's been different for every institution, but it's happening, I think, to some degree. As we know, and we talked a little bit about this earlier when we talked about bond rating agencies and creditors, et cetera, you know, S&P in general, their view of the higher education sector remains negative. But I still think that there's some opportunities, and some of those opportunities that I'm consistently hearing boards and committees talk about, you know, is really on long-term strategic planning and cost containment. Those are the two biggest drivers and themes that are top of mind of fiduciaries and fiscal leaders. We're also a significant focus on enrollment and specifically student retention, and we know how important that is to our bottom line and overall performance for the institution for the year. The other item is that, you know, COVID has been an accelerator in terms of process reengineering and innovation. And we know that your institution is looking at some of its processes, not only because we morphed to perhaps a virtual environment to some degree or hybrid type focus, but more as we move forward, how can we add some efficiency to the system and take some of the, the cost out of the system? Enterprise risk management is another trending topic. It always has been, but it continues to be of greater import in today's days and times. Focusing on making sure that it's a complete inventory of the risks. Many nascent risks were identified as a result of the pandemic, and now it's caused institutions in general to be introspective and think about, do we have this right? And is our weighting appropriate? And did we consider perhaps a new dimension of velocity? How quickly could our institution be impacted if a particular risk were to come to bear? And then we're seeing a lot of institutions not only focus on retention, as I mentioned, but the programs and supports that are available for the mental well-being of the students, as well as the employees, which has taken some institutions to look at the nature of the programs and benefits that they offer to their employees. Are they right? Were they the ones that were most needed during the period of the pandemic? And so those are just some of the broadest themes that I'm hearing, but a couple other things of note here. It's fair to say, and I know your institution as a whole has certainly been impacted by this, but more than 1 million fewer students are enrolled in college now than before the pandemic began. And that's a gulp and a gasp moment to think that 1 million students either withdrew or paused their education during this period of time. And so whether or not those students will return or to what level they will return remains still to be seen. When we think about, the effect of COVID, certainly the impacts were very varied, but public institutions in general have actually fared better. And maybe that's not exactly what your experience has been, but when we look across the higher education landscape as a whole, that has been the experience. In part, as I think everyone's probably likely familiar with, nearly $69 billion of federal funding, which mostly went to the public colleges and universities under the various federal relief programs. That was very helpful. However, it still doesn't principally or fundamentally address some of the structural issues that exist in some institutions. So when I talk about structural issues, I'm talking about core instructional delivery. So operating revenues less our operating expenses, and what sort of margin or deficit does that create for an institution during the period? So with a view towards the future and moving away from federal funding to the level that we've seen it, what remains in terms of our overall performance? And if our enrollment numbers have declined and our retention level has not been what it has historically been, how will that overall, what sort of longer term implications will that have on our institution as a whole going forward? We can talk about budget and cutting cost containment, but one of the things that I've cautioned some institutions around is to say, we are seeing institutions begin to add back budget. And we know that's a very difficult thing to do, but they're adding back budget in ways and in places that really punctuate their differentiators or competitive market advantage. And so certainly being judicious, continuing to be focused on, listen, we just don't have that sort of resources available to double down on certain things, but making sure that during this period of time, when applications, and if you haven't heard this, applications are higher than they've ever been to most institutions. It seems like students are putting a lot of applications out there and being much more selective in terms of the institutions that they choose to pursue. And so certainly making sure that we maintain what has made us a very special institution as a whole in terms of budget dollars has been an area of focus. The only two other comments I just wanted to share, certainly, when we think about strategic planning in general, what we're seeing most institutions where previously they may have said, we'll do our strategic plan and we'll align resources in future periods to align with those imperatives. Now what we're seeing is institutions say, listen, if we're going to establish a strategic objective and imperative, we want to make sure that we fund and resource that expectation initiative today. All right, because we know about the difficulties in budgeting. We know about the challenges of resourcing particular projects, and we don't want to be caught not being able to accomplish something we planned. So the last thing that I just wanted to mention is that over the next, probably within the next 30 days, we will be issuing our annual 2022 State of the Higher Education Sector Report. And in this document, we will chronicle all of the trends that we see are relevant. And these are not only specific, these articles are not only specific to the fiscal leadership, but to each of you as fiduciaries and leaders of the institution as well. So we will make sure, if you didn't see our prior year report, our 21 report, you will certainly receive our 22 publication, and we're happy to speak to you further about the articles that are included therein. So I'll pause for a minute. I promised Claire to only give you a bit of a primer. There is a number of slides included in the presentation materials that you receive that really go into tremendous detail about what we're seeing. We really surveyed the landscape of higher education. So if you haven't, take some time to look at the trends and the perspectives that were shared in those slides. Thank you.
Thank you. This is Elise. I have a question. It's one I always ask. Given all your research, and I found your slides very, very helpful, is there anybody, I know we're early in the process, is there any academic institution that is sort of distinguishing itself as an organization that is sort of addressing the impact of COVID better than others? Is there something that we should be paying attention to?
Yeah, it's a great question. A lot of institutions, I think, have coalesced around a very familiar set of, operating activities. I don't think there's any one in the portfolio that I've looked at or researched that I thought was doing something perhaps demonstratively different than the group. I'd have to reflect on that and see if there was anything more. We talked about strategy and budgeting as the two of the biggest areas. For publics, no, maybe for some of the privates a little bit, they've done some things that, perhaps they wouldn't have in a pre-COVID period.
Okay.
Nothing's coming to mind. Again, more on the private side because there's a few more levers that perhaps exist to some private institutions than some publics.
Yeah, but I know, at least a little bit I've read, I know with some of the private institutions, especially the ones with the higher price tags, there is a frustration on the part of students about not being able, sort of the remote learning versus in-person learning.
Oh, absolutely. I mean, I think everybody would say, as we would probably all say, that the experience of the virtual is very different, starkly different than certainly being on campus with faculty and students and programs and sports, et cetera. So, yeah, I mean, that certainly has been a factor.
Thank you.
I have one question. On the top strategic priorities, you give the percentage of institutions that have this order. Does the order reflect the need for change or their concerns? Because the reason I'm surprised, the last one, reforming undergraduate STEM education. Now, I would think that STEM education is very important, but it's got a 4% issue in terms of the prioritizing of the issues. It might mean that they're very happy with the STEM education programs, so they're not focusing on it versus what they're not happy with. I wonder how to interpret the priorities. I mean, our priority is retention because it's down, enrollment because it's down. It's not, and I mean, the priority with us would reflect the problems as opposed to the successes. Is that the same interpretation here?
Yeah, I think that is exactly right. Your last words, I think, were spot on, that it's more about, the concerns rather than the successes in terms of focusing. What we're doing well, okay, we'll let that be. And that actually gets to my point earlier, a moment ago, about making sure that we continue to invest in those areas that are. So in your example, if STEM is something we're doing well, then let's not let that go. Let's continue to make sure that we invest in that area.
Okay. So I see that everyone has the same problems.
It's tough right now in higher education. No question about
it. Elise, it's Rick. Can I ask a quick question? Sort of related
Absolutely.
to, thanks. It's sort of related to what Aviva was talking about too. All the literature and our own experience indicates that even pre-pandemic, more instruction in higher ed was more and more was being done remotely or virtually with technology. we have to make our own decisions from a strategic and an equity standpoint about the balance of in-person and remote learning. But where is the industry headed for that? And from a financial and cost containment and economic standpoint, is there advice we could benefit from as we weigh these other issues along with that? Thanks.
Yeah, and Claire may have some perspective on that as well. You know, the concept of online delivery instructions, I think we all know, is not something new. It was just forced upon many institutions that maybe never previously were involved in that type of instructional modality. The concept of MOOCs, as we've probably heard, these massive online courses, et cetera, and how for-profit institutions have used that as a mechanism to further their causes. I still believe, at least in the crystal ball and the crystal ball that I'm watching, the signals I'm seeing, that, the traditional educational format, if anything, COVID has kind of reinforced that there is that desire. There's something visceral about that on-campus instruction that at least that aspect of it will certainly endure. Whether or not institutions may toggle between offering some continued level of instruction virtually in a post-pandemic world, I think it's more likely than not that they will, to meet the needs of certain non-traditional students, the lifelong learners, the parents, the other individuals that had to pause or stop because of education or other family commitments, et cetera. But I still believe that the current model will endure. I hope that was helpful. That's one man's perspective.
Thank you. Yes.
Any other comments, questions? Claire, anything that your team wants to add?
I think just a big thank you again to Ben, Melinda, Mike, and the rest of their team for the support during the audit process. And we will look forward to being able to issue our reports either Monday or Tuesday next week.
Excellent. And again, I want to thank the team for all the work that was done. I know this is, there was a lot of heavy lifting that went with this and a lot of teamwork. And I think that in all the time that I've been on the audit committee, this has been, even in light of the pandemic, this has been the smoothest the process has ever run. And I thank you. So if there are no other questions or comments.
I have a question.
Okay.
This is a financials question, which I've seen in a few of the financials, and it baffles me. There's a line item for salaries. I can't tell you which one in particular, but it was a couple times. And then the benefits line item is higher than the salaries. What's included in fringe benefits? I thought it was 70% of salaries or something like that number. How could it be higher? There must be something else included in it that
That would
don't
be
see.
the pension and OPEB expense. It runs through the fringe benefit number. So that's
Well,
what
I didn't hear the answer. Could you say that again?
the pension and OPEB expense. So when the pension OPEB entry,
And it would be on the same line as fringes?
Yes.
Thank you. That's back to the old pension distorting. Could you give us a rundown, Ben, just for my benefit and maybe others too, without backing out all the pension stuff? What do you see? I see the cash flow isn't negative. It looks to me like we're operating at about a $200 million deficit in operations. What is the operating deficit system versus community colleges? Forgetting the pension issues.
Ben, you're on mute.
Yes, we have gone through and made our adjustments to net position that came out of the audit based on our practice of excluding the impacts of OPEB and pension liability. And on that basis, but this year I have to caution you, the federal funds that came into the system,
Right.
we were required to the way that the federal government set up all these federal funds is that they were sort of two components. There was a student piece we had to give out to the students and a institutional piece that we could use to shore up our institutional finances. And the way that the law was designed, we ended up earning the institutional funds by giving out the student funds, by distributing the student funds. So in the case of the colleges and maybe to a lesser degree the universities, we were ahead. We took a very aggressive policy and approach to giving out the student funds. So on June 30th, we'd given out a bunch of student money, more than we had. So we had earned through the process more institutional funds that we had planned to use this year, not last year. So the result of that is that our net position on June 30th is somewhat higher than it would have than it might otherwise look, because we had earned some institutional funds that we have planned to expend this year. We're trying to identify that, but that would tend to result in the net position increasing as of June 30th from the prior year because of these additional federal funds. So leaving aside that one caveat that some of the increase is a result of that, our overall reserves, which is net position less pension and OPEB, went from in the community colleges from $32.6 million on June 30th of 2020 to $55 million on June 30th of 2021. So we picked up about $23 million in reserves. Now again, we're trying to tease out exactly how much of that is related to federal funds. And the remainder is largely because we underspent during the year. Remote operations tend to, certain historic spending patterns don't happen. We've had a lot of people, we've had higher levels of attrition. It's been very difficult to replace people, especially because the finance department is slow to approve new hires, given our financial condition. And so we ended up underspending. So an improvement of about 23 million in the colleges. In the universities, our adjusted UNP in June 30th of 2020 was $126 million, and that rose to $160 million. So again, about $34 million in improvement in the university's net position. Again, some related to federal funds, some related to a general austerity and lower spending. In the case of Charter Oak, it went from 5.9 or just under $6 million to $6.9 million. So an increase in almost $1 million at Charter Oak, which in percentage terms is a fantastic result for them, and begins to put their reserves at a level that is, I think, appropriate. Charter Oak is in great shape financially, and give Mike and his team there a lot of credit for that. But actually, I have to tell you that colleges and universities did pretty well in a strange year. I mean, we have enormous challenges coming up ahead of us. So just as we squirreled away as much as we could in fiscal 20, it is as management, I am attempting to squirrel away as much in fiscal 21 as well. We squirreled away in fiscal 21. We are attempting to do exactly that in fiscal 22 to the greatest extent possible, because fiscal 23 is with the absence of continuing federal funds at the level that we enjoyed during the pandemic. We have a built-in deficit that's very large. I'm actually trying to come up with a much more solid estimate of that as we go into the legislative session, because I'd like their help. But that is, it would be easy to tally it up on a piece of paper and get to $100 million for the whole system, or even $150 million for the whole system of funding that we will have to make up for between the loss of federal funds, the resolution of our collective bargaining agreements, and just general inflationary increases that we have to deal with each year. So we are doing well right now in anticipation of a very difficult few years as we deal with our lower enrollment and lack of continued federal funding. So
I guess I have to study that
I never say good news without qualifying that the bad
Yeah.
news is coming.
But strictly on operations, without the federal funding, we're losing on an annual basis. If we didn't have federal funding, forget COVID, even before that, we're losing from strictly operations. After state and federal funding, we still have a deficit. You're anticipating, did you say 150 million?
Well,
In the whole system and colleges, or?
yes, although give me a time to make that number better. So in this audit report, we improved our net position by $55 million, $56 million.
You improved by, or was resulted at 55 million?
No, we went, the total system reserves went from 164 million to 222 million over during the fiscal year. However, this was a year in which we,
yeah, I understand.
We used a lot of federal money that propped us up to that point.
Right. So that doesn't count. Really, what counts is going forward. Luckily, it stemmed the disaster. So what we really need to do is increase enrollment materially.
Yes, but we've also socked away some of that federal money. I mean, the fact that we were able to improve
offset the loss coming forward.
Exactly. So we're trying to put ourselves in as strong a position as possible, understanding that, you know, it certainly may well be a possibility that we will recommend use of fund balance to balance the budget in fiscal 23. I would rather not do that. That would be, you know, the last thing I want to do is to use our scarce reserves to balance our budget next year. But, you know, I'm a realistic person. We may have that as an option along with other management actions that are not, you know, of interest to the board as well. I mean,
is the consolidation, has the consolidation going forward going to be reflected as a saving, create a savings in that projection, or have you included that?
Well, this does reflect, I mean, our operations through June 30th of 2021 clearly reflect, in my view, a cumulative savings of about 20 million, just under $20 million when I did the math last year, where we have shed staff through attrition and replaced them at lower rates and reduced the size of our workforce through attrition, which has been in large part available to us because of the change in organization. So we have seen some savings. We would be in worse shape if we hadn't made that change. I will caution that over the next 2 years, as we really roll out, the one college needs to be now functioning at a level that the accreditors are willing to accept them as the successor to the existing community colleges. In order to do that, we are entering the period in which there will be some level of sort of doubled up expenses. I think that number is probably in the order of magnitude of about $10 million a year in fiscal 22 and 23 that we will be sort of having to spend simply to make sure that the transition occurs smoothly, that we have all the resources in place to function as one college and that the accreditors are satisfied. And then I think that will go down once we've done that. It comes at a tough time because of the pandemic and and the enrollment problems that we're facing. But I'm confident that we'll find a path through that. And again, I think that this audit shows our success at you know, improving. I mean, we have tough finances, especially in the colleges. The $36 million is not enough reserves. Or 32 million that we had at the end of fiscal 20, but we're back up a little bit in order to, you know, steel ourselves for what's going to be a tough period of adjustment.
Thanks a lot. Thank you very much.
Any other questions, Rick?
No, thanks, Elise.
Ben, thanks for the comprehensive review. That was very helpful. So if there are no other questions or comments, I'd like a motion for adjournment.
I so move.
Actually, Elise, I have an information item that will take me just 5 minutes if you would give me the.
That's fine. Please, go ahead.
I believe we need Cone Resnick to present their report first.
Oh, we need Cone Resnick as well? Do you want to let them
Yeah.
go first? Melinda?
Yeah, I mean, yeah, let's do Cone Resnick first. Carolyn, are you on?
Okay. I didn't realize there was another item. I apologize.
Oh, that's all right. I've just been sitting here quietly listening to this discussion. Wow, that's a heavy discussion to follow. I think ours is going to be really easy and quick. I won't keep you guys that long. Thank you for inviting us to this meeting. We are here to present the results of the Connecticut State Colleges and Universities Systems 2020 construction audit for June 30th, 2021. So this is last year's audit really, and it just kept getting postponed a little bit. But it's a very clean opinion. There were no issues encountered, no disagreements with management, no material weaknesses or systemic issues that were noted. It was very clean, no surprises, no issues encountered during field work. The reported expenditures for 2021 were slightly up from the prior year. So the prior year, we reported approximately $66 million in construction expenditures. For 2021, it was $74 million, so a slight increase over the prior year. But again, there were no issues noted, no disagreements with management. Fieldwork went off without a hitch. So thank you to everyone who was involved in that effort. I do also have Alexandra Marsh on the line in case there were any specific questions regarding fieldwork, but I think other than that, you should be really good. Melinda?
Thank you, Carolyn.
You're welcome.
I have nothing to add.
I think you mentioned that someone was on the line. Is there another report to follow? I'm sorry.
Oh, no, I'm sorry. It just cut out for a minute there. Technology this morning with this weather, I think. There are no other reports from Cone Resnick. That was the one and only report. So Cone Resnick is easy peasy.
And I am very sorry that I overlooked that.
Oh, no problem. It's okay. Thank you.
Okay. Are there any questions or comments about the report that we just heard, which was very positive? If none, Rick, I'm going to turn over to you for your question.
Oh, no, I'm fine, Elise, at this point. Thank you.
So, Elise, I'm going to give a quick information update on a policy question that I think is of relevance to the audit committee. And I'm sorry to do it at the end.
I'm sorry. Can you identify? I feel I'm still flying blind here. I'm so sorry. But who's speaking?
This is Ben, Elise.
This is Ben. Oh my God, I didn't recognize your voice. Okay.
I have a little cold. I'm going to give a final discussion item related to our efforts in the college arena to revise our community college policies. As part of the merger, we identified, and the accreditor has identified, that the system's policies should be updated to reflect our change in organization. And frankly, some of our policies are holdovers from the Board of Trustees and merit a review anyways. So this is a good opportunity for us to go through the full breadth of community college policies and bring them into alignment with the organization that we are moving toward. In particular, I want to talk about a few audit-related policies. I am undertaking a process now of going through all the sort of finance and audit-related policies as a first step. We're also, there's some others about campus operations and things that we will get to later on in 2022. But my initial effort is going to be to present a redraft of the audit and finance-related sections of our current legacy policy manual. And if you look on page 256, 257 of 264, so the very end of the board packet, is a staff report. I've also provided a version of the staff report to the Finance Committee. Ultimately, I believe that the Finance Committee would be the one to refer policy to approve these policies, and there's considerable overlap, if not 100% overlap, between your membership. But I thought it would be helpful to highlight the audit-related policies to this group. So what we're trying to do with this policy review is first to update references. The existing audits policies refer to chancellor and colleges in the plural, and we're making those references so that they are in line with the organization. So just changing specific references to match. We are also, the current practice of the board has been to provide policies at a reasonably high level with the understanding that the implementation of those policies will be done in many cases through procedures which are administrative only, so that so that certain tasks are delegated to the administration rather than having to have the board revisit for operational issues that may come up, and to ensure that the policies they have a longer shelf life if there are fewer specific procedures built into them. So we are recommending certain areas where we strip out certain features of the pre-existing policies because we think they are administrative procedures, and all those will be clearly identified. And then there are a few substantive changes that staff recommends, and one of those is in the area of audit. So in the staff report is essentially an index from the existing policy manual. There's a link so that you can read what those all the original language is, and you can see our efforts to redraft those. There's sort of how we're handling certain ones that are just being repealed or have been previously repealed by policy actions, and we'll remove those. Others we're recommending be repealed simply because they're no longer pertinent, and then others are being we're proposing adjusted language. If you look, there are a set of called section 6.4 of our original manual includes policies related to accounting and financial reporting and auditing. And we have, and I thank Melinda for her efforts to draft this. We have gone through and redrafted those completely. The old ones, I think, did not reflect, Gatsby standards and our current audit practice. How we develop our audit reports. So we've gone through and are proposing a policy that we think is in line with current Gatsby standards and our practices, and points out how that will, what we will be reporting on in line with our current reports. In addition, we've proposed a section on reserves and unrestricted net position. I'm not entirely satisfied with this because it currently seems to rope in the universities, and I think we're going to handle the university and college policies separately for the time being. There may be some that are across the system, but the financial policies will probably separate that out. But it basically enshrines our practice of reporting on system reserves by making adjustments to our net position to exclude the impact of pension and OPEB liability. We have been doing this for some time, and I think it makes sense to do it, and I defend the practice as a reasonable way to understand our reserves. But I feel as though it is better for us to have a specific policy that dictates we report it this way. In that way, in the event that there's some change in how we report this, or the Gatsby rules necessitate a change, it'll come back to you and you'll understand what it means when we report on reserves for the components of the system or the system as a whole. So that's that language that we are proposing, as well as the language we are proposing to replace in that section 6.1 of the existing policies is all included in your packet. But we will be providing to the board through the finance committee a more, a complete version, still a little bit in the works, of our redrafting of those finance and audit related policies for you to look at. We're still, this is a process that I think may take a number of months to conclude. The policies are complex and long, and I don't, there's no enormous hurry that we get all these resolved. But on the other hand, we wanted very much to have this process be underway when we went to the accreditor and asked them to approve our substantive change to the creation of the one college. So by my making these initial reports and describing the process to you, I believe we can say the process is underway. And I look forward to hearing back from you individually or in whatever context makes sense to discuss some of those changes. I would happily accept, and will make available to the larger board. If you read over this and have concerns about it or questions, feel free to direct those to me, and I will not only try to answer your questions, but also reflect your perspectives in the draft that we make available to the board. Again, when we make a full draft, I expect we will go through at least several months of board cycles before we ask for approval of these in order to give everybody multiple opportunities to ensure that these policies reflect the direction you want to go. But I didn't want to get this process underway without explaining it to you and particularly identifying that there were some policies that govern the functioning of this board, of this committee, that are a part of that, and those are included in your staff report. So that's my report, Madam Chairman. Thank you.
Just you just said that you expect that there'll be various iterations of this. Do you have a targeted time frame under which you think this could be sort of presented to the board?
Yeah, well, yes. I am intending, I'm looking at the calendar with a little bit of trepidation, to provide a draft of, I am going to provide a draft to the Finance Committee for its review. It's possible that there will be some sections which we are unable to resolve, but I expect to have most of the policies that are shown in the little table in the report be included in a redraft, a first draft to the Finance Committee in February. There are a couple of other, we are also going to include policies related to foundations at that time, which I believe are available in draft. So there will be I don't know, probably going to be 20 or 30 pages of draft. Well, maybe not 20 or 30. Hopefully it's good. We're trying to be brief. It will be, a significant amount of redrafted policy for the board to consider. And then I expect that we will end up doing 2 or 3 additional rounds of policy revision, probably outside of the Finance Committee, because most of the other areas of policy impact campus operations or academic matters and the like. And there's a parallel process going on in academic affairs to revisit the academic policies in light of the merger. So I'm hoping to get all of it in front of the Finance Committee where it can stay for a few months until the Finance Committee has a busy and arduous agenda over the next several months because it's springtime and that's when the Finance Committee is so busy. So we may put it on there and introduce it, and I'll work with the chairman to determine the schedule for getting that resolved But like I said, I anticipate several months before we would take it up for final action.
Okay, thanks, Ben. Eva or Rick, any questions or comments of Ben?
We're set. I'm all set. Thank you.
Appreciate the heads up on that. Thank you.
A lot of work. What is and I know, I realize we have to go through the board. Is there a targeted time frame to get back to the accreditation organization?
I believe that they have a date in March for submission of, I'm not in the middle of the, thank heavens, I have enough work. I think it is in March is the date for submission.
No, actually, they're due to submit the substantive change report to NECHI in mid-February for a response back to us in March sometime. So they are getting, yeah, they are defending, I guess, if you consider it a doctoral dissertation kind of thing, they'll be with NECHI, I believe the 2nd or 3rd week of March with a response shortly thereafter. However, there is a section in the substantive change report that walks through some of the activities that are going on to create the single college, to create Connecticut State Community College. And one of them is this activity related to policy and procedure and how it will reflect the activities of the single college and the work that it's going to take to get us there. So this activity is as an ongoing activity in the substantive change report.
Thank you. Okay, Ben, do we have any other information to present to the committee?
No, we do not. I believe we have concluded our business.
Okay. So I did this a little prematurely before, so now may I have a motion for adjournment?
I so move.
Second.
And a second?
Second.
Second. All in favor?
Aye.
Aye. And with thanks again to the board, to all of the reports that were presented today. This is a very comprehensive amount of information we received today. So on behalf of the committee, thank you. Yep. And with that, we are adjourned.
Thank you.
Thank you.
Thank you.
Thanks, everybody.
All right, then. Bye-bye.
Bye.
Your live stream has ended. Thank you all.